Hello, Vetted VA. This is Hammer. Today is March 13th, 2024. I am here with your mortgage market update, letting you know what's going on with mortgage rates in the mortgage market this week and where we think mortgage rates are headed from here. So, with that said, let's go ahead and have some fun, talk about what it is that we're doing here. I'm glad to see all of you here. Let's start off with a quick rate. Actually, you know what? Let's go ahead and hit the slides here. If you are watching on the replay, do me a favor, just put a hashtag replay in the comments. This post is monitored, but we do like to see what you guys have to say and who's watching. Also, don't forget, we want to make sure that you're getting a lot of value out of this. So ask any questions that you have. But let's go ahead and talk about rates. Remember, this is not an offer to lend. And when we do talk about rates, we're talking about generalities and averages. You do want to make sure that you are shopping your rates. So where do we stand this week? Well, quick recap, mortgage rates, they've improved just a littlest bit. Mortgage rates are generally unchanged for much of the week. They did move a little bit lower on Thursday and Friday as we got some economic and labor data. Although there were more jobs created last month than what was expected, we did see the previous month's numbers revised to have less jobs created than originally reported. Higher unemployment and wages helped as well. Generally, it means you're going to see VA rates that are in the mid to high sixes is a good rule of thumb. Conventional rates, if for any reason you're not using your VA benefit, you're going to see conventional rates generally in the low to mid sevens. That's going to be a general, area. Now, again, so where we're going though, things are getting a little bit more volatile, and this week we could see rates move higher. Now, we had inflation data just a couple of days ago, actually yesterday, with the that came in, and with that inflation data, it didn't come in nearly as well as we were hoping. It showed that inflation continues to be resilient. It's just not going away. It's moving slightly lower. What that does is it sets it up so that the Fed is unlikely to cut their Fed funds rate anytime soon. Now, the Fed, they can't control mortgage rates. They don't control rates throughout the economy, but they do influence them. And the way they do that is with their policy rate called the Fed funds rate. Now, when the Fed lowers that rate, it's going to help mortgage rates to go down. The problem is, it does not look like the Fed needs to lower that rate anytime soon. Now, we have a Fed meeting next week. Definitely not going to lower it there. We have another Fed meeting that is May 1st. Right now, very unlikely we see any rate cuts at that meeting as well. That pushes us out till June. The good news is mortgage rates will improve before the Fed starts actually cutting rates, but they're only going to improve once we have some clear signs that the Fed needs to cut rates. Let's take a minute and talk about why would the Fed actually need to cut rates? Why would they bring this rate down? And why is the rate up where it is to begin with? Well, the Fed had to raise rates over the last 2 years in order to curb inflation. Inflation was a big problem after the pandemic and all of the responses and activities related to it, the lockdowns and all of that, right? So we know that things were getting expensive. In June of 2022, inflation, 22. Inflation hit a high of 9% headline inflation, 9%. Now that headline inflation is down to about 3.2%. I'd have to double check, but regardless, it's in the threes. That's why you might have heard in Biden's State of the Union address, he talked about inflation going from 9% to 3% and how it's the best in the world. It's not, but anyway, but we're not going to see mortgage rates really move much lower than these sixes and sevens that we're seeing until the expectation is the Fed is going to be able to cut rates. Now, why would the Fed cut rates? Well, they would cut rates because the economy starts to slow down or the labor market weakens. And that's why I'm always talking about labor market data and economic data that comes out. And they would start to cut rates when inflation actually drops where they want it to be, around 2%. So this week we did get some inflation numbers. They were not really that spectacular. There was a little bit of reduction in overall inflation, but not enough to get excited about, not enough that really puts us in a position where the Fed is going to feel comfortable cutting rates. Now, there's a consensus starting to build behind the scenes that maybe the Fed needs to hold off from cutting rates. It needs to keep things where they're at. We call that higher for longer. What that means is we're likely saddled with these mortgage rates for a bit longer. So let me pull the slides up just because I do have this prepared, and let me try to show you. So what I think is going to happen, here's where I think things are going to go. Over the next 15 days, the next couple of weeks, I think rates are going to be moved by whatever happens at next week's Fed meeting. And that meeting is going to be concluded on March 20th. And what's going to happen is on the 20th, we're going to get a couple of things happening. Number one, we're going to get the Fed releasing their policy statement. They could raise rates, they could cut rates, or they're going to keep rates the same. Almost a full consensus. Everybody believes the Fed's going to leave rates exactly where they're at. They don't need to raise rates. They would do that in order to continue to slow things down. And they're happy with where things are at, but they're also not ready to cut rates. They're not seeing enough signs that the economy is in distress. And they'll cut rates once they see that the economy or the labor market are in distress. And that's what they're kind of waiting for. So it's likely that we're going to get some different momentum coming from that Fed meeting. So they're going to release their policy statement, and then they're going to also release what's called a dot plot. Now, at the end of last year, every quarter, by the way, the Fed releases a new dot plot. And what a dot plot is all of the either 18 or 19 Fed members are polled anonymously, and they say where they think rates are going to be at the end of 2024, 2025, 2026. Now, at the end of December last year, we were expecting to see that the Fed funds rate, currently at 5.25, would be at 4.5 at the end of this year, which would mean that we would see three rate cuts, and they would be about 0.25% each. And the idea back in December was that we were going to see those rate cuts start in March. And that's why we saw some of the best mortgage rates we've seen in a long time. After peaking at highs in October, we saw some much better rates in December. Where does that leave us now, though? The problem is that now we're not expected to see that rate cut until maybe June or July. So that's why let me give you the third thing, then we'll get into that. So the third thing is going to happen is we're going to have the Fed's press conference. Fed Chair Jerome Powell will answer press questions, and that press conference always has a lot of influence on mortgage rates and could affect whether we see a response that's bad for mortgage rates or good for mortgage rates. We'll talk more about that next week. So over the next couple of weeks, rates are going to move in whatever direction they're led by that press conference, by the Fed statement, by the dot plot. Now, that's the next 2 weeks, right? The next 15 days. Now, over the next few weeks, let's call that 30 days, rates may creep up a bit if it looks like the Fed isn't going to cut until June or July or maybe even later. We're not in a position to see rates improve too much from here. What we're looking at is rates that might move, down as much as maybe 0.125%, or what we call an eighth of a point, might move up another quarter point. We're not going to see too much movement. Hopefully, we don't have to worry about seeing last October's highs again when we had rates that were up in the eights, but we're not likely to see things improve too much. As far as longer term, rates look like they're going to hold in these sixes for a while. The sixes for government loans, the low sevens for conventional, low to mid sevens even for conventional conforming loans, possibly until later in the year. We could see some movement, hopefully before June, but right now it's starting to look like that's not necessarily going to happen. It's looking like we're going to have to wait a little bit longer. So anyway, I hope all of this helps you. I think we kind of hit everything. You can go ahead and generally release these videos for each week. In fact, let me go ahead and we're just going to go back here. There you go. So I will be here next week and kind of share with you what we got going on, where they're at. If you guys have any questions, let me know. I do notice there are some live viewers on. If you have any questions, let me know and I'd be glad to answer them for you. But that's basically it for this week, y'all. I hope this helps you. If it does help you, please be sure to leave it in the comments. Give us a hashtag replay. Let us know in the comments, Hammer, this helps. You can tag me. I'm Hammer J Helmer. If you put in Hammer, it should come up with that little thing. If you're on Facebook, YouTube, make those comments. But we're here to help you, and hopefully this helps. So take care, everybody, and have a fantastic day. I'll see you next week, and bye-bye.